What if I told you that a man from Omaha, Nebraska turned $10,000 into over $100 billion using just a few simple principles? What if those same principles could transform your financial future starting today? Warren Buffett didn't get rich by following the crowd, chasing hot stocks, or timing the market. He became the world's most successful investor by doing something completely different, something so simple that most people overlook it entirely. Today, we're diving deep into The Warren Buffett Way, the book that reveals exactly how the Oracle of Omaha built his fortune and how you can apply his proven strategies to your own investments. Over the next 30 minutes, you'll discover the 12 investment principles that turned Buffett into a legend. Learn about his most profitable investments and walk away with a complete blueprint for building long-term wealth the Buffett way. Whether you're a complete beginner or have been investing for years, these timeless principles will change how you think about money and investing forever. So, grab a notebook because we're about to unlock the secrets that Wall Street doesn't want you to know. Chapter 1. The Buffett Phenomenon. Let's start with the numbers that will blow your mind. From 1965 to 2021, Berkshire Hathaway stock has averaged annual gains of 20.1% compared to 10.5% for the S&P 500. That difference turned every $1,000 invested with Buffett in 1965 into over $3.6 million today. But here's what's truly remarkable. Buffett achieved this performance using principles that go against everything Wall Street teaches. While others were day trading and chasing trends, Buffett was quietly building an empire based on 3 core philosophies. First, business perspective investing, treating stocks as pieces of actual businesses, not just ticker symbols. Second, finding companies with sustainable competitive advantages, what he calls economic moats. And third, having the patience to hold great businesses for decades. The genius isn't in complex formulas or insider information. It's in simplicity, discipline, and thinking like a business owner rather than a speculator. Buffett once said, "Someone's sitting in the shade today because someone planted a tree a long time ago." This is the mindset that separates wealth builders from wealth chasers. Chapter 2. The 12 Tenets of Buffett's Investment Philosophy. Now, let's break down Buffett's 12 investment tenets that form the foundation of his success. These aren't just theories, they're battle-tested principles that have worked for over 60 years. Business tenets. 1. Simple and understandable businesses. If you can't explain how a company makes money to a 12-year-old, don't invest in it. 2. Consistent operating history. Look for companies with predictable earnings over at least 10 years. 3. Favorable long-term prospects, industries that will grow or remain stable for decades. Management tenets. 4. Rational management. Leaders who make smart capital allocation decisions. 5. Candid management. Executives who tell shareholders the truth, both good and bad. 6. Management that resists institutional imperative. Teams that think independently rather than following industry trends. Financial tenets. 7. Focus on return on equity, not earnings per share. How efficiently is management using your money? 8. Calculate owner earnings, the real cash a business generates for shareholders. 9. Look for companies with high profit margins. These indicate pricing power and competitive advantages. 10. Ensure every dollar retained creates at least $1 of market value. Market tenets. 11. Determine the business's intrinsic value. What is the company actually worth? 12. Buy at attractive prices. Only purchase when you're getting $1 for 50 cents. These principles work because they focus on business fundamentals rather than market sentiment. When you think like a business owner, short-term price movements become irrelevant. Chapter 3. Buffett's Greatest Investments. Let's examine some of Buffett's most legendary investments to see these principles in action. Coca-Cola, 1988 to 1989. Buffett invested $1.3 billion in Coca-Cola when the market thought the company was overvalued. Why? He saw an unshakable global brand with incredible moats, brand recognition, distribution networks, and customer loyalty that competitors couldn't replicate. The key insight: Coca-Cola had pricing power. They could raise prices and customers would still buy. That's the hallmark of a great business. Today, that investment is worth over $20 billion. See's Candies, 1972. This $25 million purchase taught Buffett about the power of brand economics. See's could raise prices annually because customers associated the brand with special occasions and quality. It wasn't about the candy, it was about the emotional connection. The lesson: sometimes you pay a premium for quality, but if the business has true pricing power, that premium becomes the bargain of a lifetime. Apple, 2016 to 2017. Many questioned Buffett's massive Apple investment, thinking he didn't understand technology. But Buffett saw what others missed. Apple wasn't a tech company. It was a consumer brand with an unbreachable moat. iPhone users rarely switch to competitors. They're locked into an ecosystem of apps, data, and habits. That customer stickiness generates predictable, recurring revenue. Exactly what Buffett looks for. The Washington Post, 1973 to 1974. During the Watergate crisis, Washington Post stock plummeted. Buffett saw a company trading for $80 million that owned assets worth $400 million. The market was focused on short-term troubles while ignoring long-term value. The principle: great investors buy when others are selling in panic. Fear creates the best opportunities for patient capital. Chapter 4. The Power of Focus Investing. Here's where Buffett's approach gets controversial. While modern portfolio theory suggests diversifying across hundreds of stocks, Buffett concentrates his bets on his best ideas. Berkshire's top 5 holdings typically represent over 70% of the portfolio. This isn't reckless gambling. It's calculated confidence based on deep research and understanding. The focus investing logic. If you've done your homework and found a wonderful business at a fair price, why dilute that opportunity by spreading money across 50 mediocre investments? As Buffett says, diversification is protection against ignorance. It makes little sense if you know what you're doing. The circle of competence. Buffett stays within industries he understands deeply. He avoided tech stocks for decades because they fell outside his circle of competence. When he finally invested in Apple, he studied the business model for years first. The 20-slot rule. Imagine you had a punch card with only 20 investment decisions for your entire lifetime. How much more careful would you be? This mental model forces you to wait for truly exceptional opportunities rather than constantly trading. Risk versus uncertainty. Buffett distinguishes between risk and uncertainty. Risk is the possibility of permanent capital loss in a well-understood business. Uncertainty is not knowing what might happen. He embraces uncertainty about short-term prices but avoids risk of permanent loss through careful business analysis. This approach requires patience and discipline, but it's how fortunes are built. One great investment can outperform dozens of average ones. Chapter 5. Understanding Business Economics. Buffett's secret weapon isn't stock picking, it's business analysis. He evaluates companies the same way he'd evaluate buying the entire business. Economic moats. The ultimate competitive advantage. A moat is what prevents competitors from stealing a company's customers and profits. There are several types. Brand moats. Companies like Coca-Cola, Disney, or Harley-Davidson have emotional connections with customers that transcend rational purchasing decisions. Network effects. Businesses like Visa or MasterCard become more valuable as more people use them. Each additional user makes the network stronger for everyone. Cost advantages. Companies like Costco or Walmart have scale advantages that smaller competitors can't match. They can offer lower prices while maintaining margins. Regulatory moats. Utilities and some financial services have government-granted monopolies or high regulatory barriers that keep competitors out. Return on invested capital. Buffett looks for companies that generate high returns without requiring constant reinvestment. The best businesses are like toll bridges. Once built, they generate cash flow for decades with minimal additional capital. The reinvestment opportunity. Can management reinvest profits at high rates of return? Companies that can compound internally are more valuable than those that must return all profits to shareholders. Customer switching costs. How expensive or difficult is it for customers to switch to competitors? Software companies often have high switching costs because changing systems disrupts operations. Think about your own purchasing behavior. Which companies do you buy from, regardless of price? Those are the businesses Buffett wants to own. Chapter 6. Valuation. The art of determining intrinsic value. This is where many investors get lost, but Buffett's approach to valuation is surprisingly straightforward. Owner earnings, the real profit. Forget reported earnings. Buffett calculates owner earnings, the actual cash a business generates that could be distributed to owners without harming the business. The formula: net income plus depreciation and amortization minus capital expenditures minus additional working capital requirements. The discounted cash flow method. Buffett estimates how much cash a business will generate over its lifetime, then discounts that back to present value. If he can buy the business for less than its intrinsic value, it's a good investment. The margin of safety. Even with careful analysis, predictions can be wrong. Buffett only buys when the market price is significantly below intrinsic value. Typically, at least 25 to 30% discount. This margin of safety protects against errors in judgment. Growth versus value. A false distinction. Buffett doesn't separate growth and value investing. Growth is simply a component of value. A company growing at 20% annually is more valuable than one growing at 5%, assuming both growth rates are sustainable. The bond alternative. When evaluating stocks, Buffett compares them to bonds. If a 10-year treasury pays 4%, he wants businesses earning significantly more than 4% on his investment to justify the additional risk. Price versus value. Price is what you pay. Value is what you get. Markets are emotional and often price securities far above or below intrinsic value. Patient investors profit from these discrepancies. The key insight: you don't need complex models. You need to understand the business well enough to estimate its future cash flows with reasonable confidence. Chapter 7. The Psychology of Successful Investing. Here's the part most investors ignore: the mental game. Buffett's success isn't just about picking great businesses. It's about having the right psychological framework. Mr. Market, your manic depressive partner. Buffett uses Benjamin Graham's allegory of Mr. Market. Imagine you own a business with a partner who offers to buy your share or sell you his share every day. Some days he's optimistic and offers high prices. Other days he's pessimistic and offers low prices. You can either take advantage of his mood swings or ignore him completely. You should never let his daily quotes determine your assessment of your business's value. Emotional discipline. The stock market is designed to transfer money from the impatient to the patient. When everyone else is panicking and selling, that's when the best opportunities appear. When everyone is euphoric and buying, that's when prices become dangerous. The importance of temperament. Buffett attributes his success more to temperament than intellect. You don't need to be a genius to be a successful investor, but you do need emotional control. Long-term thinking. Buffett's favorite holding period is forever. This isn't just a catchy phrase. It's a fundamental shift in mindset. When you think in decades rather than quarters, you make better decisions. Learning from mistakes. Buffett openly discusses his investment mistakes. He missed opportunities in technology stocks and held some declining businesses too long. But he learns from each mistake and adjusts his approach. The power of saying no. Most of Buffett's wealth came from saying no to thousands of investment opportunities and concentrating on a few exceptional ones. The ability to wait for the right pitch is crucial. This psychological framework is available to every investor, regardless of education or resources. It's often the difference between investment success and failure. Chapter 8. Applying the Buffett Way today. So, how do you implement these principles in today's market? Let's make this practical. Start with your circle of competence. What industries do you understand? What businesses do you interact with regularly? Start there. You probably understand Amazon, Apple, or Netflix better than you think. Build your research process. Read annual reports. Listen to earnings calls. Study competitors. Buffett spends 80% of his time reading. Information is the raw material of good investment decisions. Use modern tools. While Buffett's principles are timeless, you have advantages he didn't. You can access company financials instantly, research competitors globally, and analyze industries in real time. Start small and learn. Don't bet everything on your first few ideas. Start with small positions while you develop your analytical skills and emotional discipline. Focus on quality. It's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Quality businesses compound value over time. Think in decades. Choose companies you'd be comfortable owning if the stock market closed for 10 years. This mental exercise forces you to focus on business fundamentals rather than price movements. Common mistakes to avoid. Don't chase performance. Don't try to time the market. Don't diversify into ignorance. And don't let emotions drive your decisions. The beauty of the Buffett approach is its simplicity. You don't need expensive software, complex models, or inside information. You need patience, discipline, and the wisdom to buy great businesses at reasonable prices. Warren Buffett's path to becoming the world's most successful investor wasn't built on luck, insider information, or complex strategies. It was built on simple principles consistently applied over decades. Let's recap the key takeaways. Think like a business owner, not a stock trader. Focus on companies with sustainable competitive advantages and honest management. Buy when prices are significantly below intrinsic value. Hold for the long term and let compound interest work its magic. Most importantly, develop the temperament to stay calm when markets are chaotic and patient when opportunities are scarce. Here's your action plan. Start by identifying 5 to 10 companies within your circle of competence. Study their annual reports, understand their competitive position, and calculate their intrinsic value. When Mr. Market offers you one of these businesses at a significant discount, be ready to act. Remember, you don't need to be right very often if you're very right when you are right. The Warren Buffett way isn't just about investing. It's about building wealth through patience, discipline, and sound business judgment. These principles have created more millionaires than any other investment approach in history. If you found this valuable, hit that subscribe button and ring the notification bell. Next week, we're diving into Charlie Munger's mental models and how they complement Buffett's approach. What's your biggest takeaway from the Warren Buffett way? Drop a comment below, and let's discuss how you plan to implement these principles in your own portfolio. Until next time, remember, time in the market beats timing the market, but only if you're investing in quality businesses at reasonable prices. Now go build your fortune the Buffett way.